Looking at the real scenario we have in front of us presents us with severe challenges. There doesn't seem to be any way out of this mess at this point. We've simply gone too far. Banks will fail, companies all over the world will go belly up. Central banks will pose as the savior as they print money out of thin air and buy up assets. Are you ready? You came here for the truth, so let me unveil that for you. Today we have two major topics, that is Deutsche Bank and Ford. This is very important because we're talking about two multinational corporations that have spread themselves everywhere and yet are not doing well. They are suffering, and it's not because of what's happening at these individual companies. This is going on all over the world. I wanted to touch on some of the points today, and I wanted to begin by taking a look at this. You're looking at Deutsche Bank stock hitting an all-time record low. No matter where I put this particular chart, if we're going to go back on the 1 month, the 1 year, the 5 year, and all the way back, it looks bad, bad, bad. The market cap continues to dwindle. The share price continues to dwindle. And we are seeing this at a time in which the European economy as a whole has been terrible. I mean, we see this as just one small piece of the puzzle, but it's important to follow it. Now, obviously, during the Great Recession, we saw this stock, along with basically everything else, falling quite a bit. Then the recovery came in. And at this point here, this was a turning point. However, it didn't look so good for this particular company as the years went on. So while most companies started to retrace their previous highs, going beyond that, this company here didn't do well. And although there has been times along the way where the stock surges up 10%, ultimately it is now at its record low. I have done several videos over the last while talking about Deutsche Bank at a record low, but it just keeps dropping further and further. Yet we have people who think that this is a guaranteed buy, that this is where you gotta get into. I personally don't agree with that. I think the risk is extremely high, and we are seeing this at a stage that is late in the cycle, no matter who you ask. You're seeing the issues out there in the news. Obviously, they had been talking about this recently. We downgrade to sell because we don't expect operating conditions to improve anytime soon. Deutsche remains a levered market play vulnerable to external events, and rising rates are currently a distant hope. That's according to UBS. I've talked about this before. You have a situation in Europe going on today. You have negative rates. You have $11 trillion worth of bonds selling at a negative yield. This is unprecedented by any stretch of the imagination. We're talking about massive business surrounding negative yielding products. Think about what that means. You want to put something into this so-called asset that is guaranteed to lose, and yet people are buying it up. But it isn't really people, of course. It is all of these multinational corporations as well as the central banks like the ECB that are getting in because they feel that it's guaranteed, although a guaranteed loss isn't something I'm willing to take. But of course, that really rings true today more so than ever before. Rising rates are good for banks since they are able to lend out money with a profitable rate of interest. Lower interest rates can restrict the bank's ability to make profits, adding pressure on margins. And they've been dealing with this for a decade now. And if you look at where interest rates are headed, it seems like they're more likely to go down than up. I don't know each individual central bank what they're planning on doing, but you can already see in some cases the pressure is being applied downward. So we're going to focus on this over the next little while and see what's the Federal Reserve going to do, what is the ECB going to do. They've already pushed themselves into negative territory in many locations around the world, and it seems like this will be persistent. The only problem with negative rates is that as soon as you make it past this 0 point, it tends to be really very minimal in terms of the performance you're going to get out of that. You can't necessarily necessarily bring it down to minus 10% and be able to generate more out of it. It doesn't work like that. You basically are just keeping it into the negative a little bit in order to stimulate and try to get all of these different companies to move their money into some sort of asset. That's the whole point of it. But they will try to do anything that they can. I do believe that we will have massive wide-scale bailouts, bail-ins, quantitative easing, and everything in between. It's going to be a matter of fact. Deutsche Bank and Commerzbank merger threatens 30,000 jobs. So of course we saw that the talks fell through. However, this was the concern that I had. I had brought this up in a previous video, but imagine when you have these two big banks and together they're going to form this most gigantic monster, and yet they tried to force the two to meet. But ultimately what happened here was that they realized there's no benefit in doing this. There's no possible way that we can put these two together and actually fix the problems. I'm really glad, at least at this point, they have decided not to do so. I think in the end we'll have a recession of some sort, and that crisis will give them an opportunity to move on further with, if not Deutsche Bank and Commerzbank, then it'll be with somebody else. This is an article out of the Financial Times. Germany's two biggest listed lenders said that there were too many hurdles to justify pursuing a complex deal that would have formed the Eurozone's second largest lender with 1.8 trillion euro in assets and 140,000 employees. So you have to know what happens when you have these big establishments that come together, mergers and acquisitions. They fire a whole bunch of people. So we will probably see this at some point in the future. Thankfully, not now. This is not good. When you take two lenders that are not doing well on their own, you're going to put them together, you're going to create an even bigger mess. But that's what they want to do. They always want to create more problems, more potential failure, so then they can have their own excuses for why they need to print up a whole bunch of money and central banks to really claim their spot at the top in order to control everything on every single level. This is what they do. Look at Greece for an example with the Troika, how they had complete control over everything that happened in the country, and still today they are feeling the effects of that disaster. This is also out of the Financial Times. It's an opinion piece, but I just wanted to bring it to you because it's relevant. Why Goldman Sachs should buy Deutsche Bank. Imagine what would happen here. You have a bank like Goldman Sachs, one of the most powerful institutions in the entire world, completely and utterly connected and intertwined with the US government, among others. And you're seeing this here that if they were to buy them, my goodness, I can only imagine what would occur, how powerful this institution would become. There are always a crisis needed in order to take these big leaps, so I'm interested to see how this will play out in the future. Switching gears over to Ford to cut 7,000 jobs by August, including 900 this week. We were told that they were bringing manufacturing back to the United States, that the economy was doing fantastic, that Ford was going to be opening plants, but the real deal is right here. I talk about the retail apocalypse, all of the stores that are closing down, and many people say, oh, it's people buying stuff on Amazon, it's online sales, it's e-commerce, and we look at the actual data and realize, okay, while a vast majority of these companies are the JCPenney's and the Sears, you have to understand that it's manufacturing as well. This means that we've got an issue going on. You can point at one thing or another, you can pigeonhole, you can try to figure this out for yourself, but when you actually look into it, you realize this is everywhere. It's widespread and people need to wake up. Ford is laying off about 10% of its global salaried workforce. This is according to the company. It's not unconfirmed sources. This isn't something that you heard of some random guy at the barber shop. This is coming directly from Ford itself. The job cuts are part of the company's restructuring, I love that word, effort, and is expected to save the number 2 automaker $600 million annually. There are many people who are going to point to one issue going on at Ford, or they're changing over to the F-150 and making that a focus. They're looking at these cars not being built anymore. Let's wake up. For goodness sakes, we gotta wake up. Chip maker stocks plunge on report that companies are dropping business with big customer Huawei. This is just one example here, but of course that's going to have an impact. We look at the chip makers as being a bellwether, as being a warning indicator of things to come. So let's keep our eyes on this here, because this is one very important thing in the cycles that do appear time and time again. I just wanted to let you know that everything you're seeing here is all information everybody should know. The mainstream financial media should be covering this data. They do point it out, but it's at the back. It's not focused on. The financial analysts will never touch it. All we get are the cheerleaders saying, rah, rah, now is the time to buy, but I ain't buying it, okay? I just want to let you know that no matter what, don't worry, don't panic, everything is fine. If you found this video informative, please give me a thumbs up. When you give me a like on this video, you're supporting me, supporting this channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need. You can get all the details at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you haven't seen it already, this video is directly connected to the one you just watched. I get into all the details. You need to see it. Click on it and I will see you there.